Hello, welcome everybody, and welcome to this weekend weekly market recap for the week ending February 7th, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It is a pleasure to be with all of you today. Looking back at the action last week, of course, we did have a couple big jobs reports. We had the ADP employment report come out on Wednesday, and then the bigger January non-farm payrolls out on Friday, and it did show us that the economy had cooled a little bit. The jobs report on Friday came in a little bit less than expected, 25,000 jobs less to be specific there. But the December non-farm payrolls was revised higher by 50,000 jobs. So there really wasn't the pullback or the Goldilocks scenario for the market, at least not in my opinion. I think that would have come probably with a little bit fewer jobs, and certainly without that revision to the December number. But I think the bigger problem maybe within that report was the I think it was the average hourly earnings, which was expected to come in a rise of 0.3%. It actually rose 0.5%. So a little bit of wage inflation in there. And right now, that inflation is just a bad word. The market doesn't want to hear it. And so we had another big reversal on Friday. The way the market set up the beginning of the week through the end of the week, it was almost like Groundhog Day, if you ever saw the movie with Bill Murray, where he gets up every day and he just starts the same day over and over and over again. Well, the last 2 weeks looked almost identical, and I'll show you that in just a minute. But overall, I thought it was just kind of a so-so week. There was some not so great rotation, maybe some areas a little bit better than the prior week, but still not great, not what we really want to see when the market is trying to move up to test all-time highs, which is what it did on the S&P 500 at the end of the week. Never could quite get there, and then we finished weak again on Friday for the second straight week. So it's going to be interesting to see how we open up Monday morning, but I do believe that at least the way we finished on Friday points to another lower open Monday morning. We'll see whether or not we hold on to support if we do head down to start the week. Let's go ahead and take a look at some of what happened this past week in terms of the major indices. You can see the only index that was up last week was the NASDAQ 100, which rose just barely, fractionally, really not even worth discussing. Nothing else really took a big hit, although you can see the mid-cap 400 was down a full percentage point for the week. Transports just can't get a bid under that group, down almost 1% as well. Dow Jones down 0.5%, S&P down 0.25%, and the Russell down about 0.2%. So overall, not a great week. I think the market is trying to make that breakout, trying to show some strength. And when we look seasonally at the market, the second half of Q1 historically does much worse than the first half. So we're almost through. I mean, we get through this week, and that will be the end of the first quarter. And so a lot of the anticipation for quarterly earnings, will be behind us. And then it's going to be kind of what are we going to do on the news? It was a buy on the rumor kind of, but then a lot of times we get the sell on the news second half of the first quarter. Like I said, typically not great. So I think we're setting up for weakness as we move forward, but the market can certainly just absolutely shock us from time to time. So we'll see what happens and we'll go with it. But there's still certainly some warning signs that we need to be aware of. Looking at the Dow Jones, you can see, let me annotate this and move that up just a tad. Got that annotation, but really need to, right there is the double top that you can see that came in on the Dow. Now, this could be viewed a couple of different ways. I mean, you can see the move higher. And by the way, I think this is bullish. I think this is a bullish pattern no matter how you look at it. But the question is are we going to go through a period of consolidation, or are we just going to break out? The bullish argument here is that we have an uptrend and we have a cup and we have a handle back down near the 20-day moving average. So the bullish argument is we're going to bounce off this 20-day, we're going to break out, and we're going to continue to push higher off of this cup. This would actually measure, I mean, we're at, the low is down at 41.8 and the high is up over 45,000. So that's roughly 3,200 points, which would put a measurement on this at 48.2, 48.3, something like that, if we actually get the breakout. So we want to pay attention to that. But to the downside, and maybe the still a bullish pattern, but not so bullish in the near term, would be sideways consolidation, where you go up and you have some sort of a flag pattern. I mean, it could pull back maybe at some point. We'll have like an ascending triangle, or maybe we go all the way back down. I mean, we have double bottoms in here, a double bottom right around the 41.7, 41.750 level. We could be heading back down there, and that would kind of go along with the idea of maybe a an 8 to 10% pullback, maybe even a little correction, which technically is 10%. But that would be the other argument, is that, okay, we have the double top in play. We got a reversing candle. We tested the 20-day. We went up, failed again, and now we're going to go right back down through it. And if that is the case, and we do go back down below, I think you got to look at that 41.7 to about 41.8 area as the support level to watch. And that's another 2,500 points from where we are right now. So that would be a pretty big drop in the Dow. But again, that would be the key support level coming off the most recent push to an all-time high, which was back at the beginning of December. All right, so let's move on and take a look at the S&P 500. So on the S&P 500, we actually did put in a slightly higher high, and this is where I was talking about these 2 weeks just look so much alike. So if I just circle, I'm just going to show you this right here. I mean, we had the DeepSeek news 2 weekends ago, and we gapped down and we rallied back, got up to the gap resistance, and then we put in a bearish engulfing candle to finish the week. Then the next week, it was trade war, the tariffs. And so all the tariffs, the discussion of the tariffs had the market gapping down again on Monday to start the week. But what happened? We rallied back, and all the way until early Friday, we were up testing that gap's resistance area again, right around 6,100. But we failed with a bearish engulfing candlestick. I don't know if 2 times is a charm and then we go higher, or if this failure twice means that we're going to break down. I would just continue to watch the key levels. But I do think on the S&P 500, if we don't hold on to about 59.60 in that range on a closing basis, I think that opens up first to move down below 5,800, which would be another 3%. But then ultimately, this double top in here at about 56.50 and this bottom around 5,700, that 56.50 to 5,700 would be getting us very close to a correction, probably down somewhere in the 8% range, maybe a little more than 8%. And that could be a little bit of a problem for the market here, especially given that the second half of the first quarter doesn't normally do as well. We've got earnings behind us. What's the catalyst? The Fed? Good luck with that. I don't know what the Fed's going to do at the next meeting, but it's not until March. So all we can do is we're just going to be left to speculate about every economic report and what that might mean. And normally an uncertain market is not usually a market where we go a lot higher. Usually an uncertain market where we see selling first and you ask questions later. And with volatility index, not high, but higher than where I would expect, given the fact that we're near an all-time high, the market's a little nervous here. So when the market's nervous, if we get bad news, we're unable to break through these key resistance levels, we're into the second half of the first quarter, which historically is not as strong, not nearly as strong as the first half. I think all of those things, along with everything else we've talked about over the past couple of weeks, really could wear on the market here. So if we break out to an all-time high, congrats, we'll go with it. We'll see what, maybe we'll have to adjust. But if it doesn't break back out and we start to head lower early this week, I think the market could be in for a little bit of a rough ride. We'll see how it goes. Let's move on to the sectors. So on the sectors here, you can see real estate, energy, 2 groups leading. There were the only 2 groups up over 1%. The good news is we did get technology bouncing back after, I'm going to show you a chart on technology. It doesn't all look great. Financials bounced back. Banks had a really good week. And as a result, the financials look much better, breaking out, the XLF breaking out again, which was awesome. But then you got staples. You can see staples gaining 0.5%, but look at discretionary losing almost 3%. So the autos, Tesla, not great. And of course, the two biggest holdings in the XLY are Tesla and Amazon. Tesla, after missing revenues and earnings per share, has been trading down, has not really performed really very well since earnings came out. And on Thursday after the bell, Amazon reported, and even though the numbers weren't bad, they beat top line and bottom line. It was more of a buy on rumor, sell on news kind of thing. And Amazon went down, I think closing around 229 on Friday. So the combination of Amazon and Tesla both going down really weighed on the discretionary area. And yet we had staples moving to the upside. And I don't like to see that kind of a variance when we're trying to break out the all-time highs like we were on Friday. We weren't that far from it. And you've got staples outperforming discretionary by more than 3 percentage points on a day like that. Doesn't give me very good feelings about this upcoming week. So that's why I keep talking about and keep giving you some warnings. The XLK. So if we look at this sector, and I just want to bring it up because the last few months, you can see we made the move up, but it's just a lot of gaps up, gap ups, gap downs. We just haven't been able to push through to new highs on the XLK. When we finally did so in mid-January, we followed it up with a bearish engulfing, and that was an island cluster reversal. We went up, gapped up onto this island, traded sideways for 3 days, and then gapped back down. And we haven't been able to get through the bottom of this gap resistance. We got right up to it on Friday and then printed that bearish engulfing candle. So again, it's just setting up. Maybe I'm wrong. For those of you on the long side, I hope I'm wrong. But it certainly looks to me like the market is rolling over or trying to roll over. And at the bottom of this chart, you can see technology down here, not too far recently from a 52-week relative low versus the S&P 500. That's not good. Not when the XLK makes up 32.5% of the S&P 500. If you got 1/3 of the entire index in this one area that's not performing well, what are the chances that you're going to break out? So if the market does want to move back up and break out, I think technology has to change quite a bit. I think the appearance here has to change, and they got to get going. They got to get moving to the upside, not just on a absolute basis, but on a relative basis. They need to lead back to the upside, and we're just not seeing that right now. The 10-year Treasury yield, the TNX, pulled back. This is a 5-year weekly chart, and I just wanted to show you that we came back down and we tested this 20-week moving average after going down for, so far just about every week this year. We have tested this rising 20-week EMA, but we haven't broken below it. We tested it back at the beginning of December and kind of held right there. So I think this is going to be a key area too. When we got down to that 20-week EMA, we bounced back up, later in the week. And I think part of that was because of what we saw coming out of that jobs report on Friday. All right. If you're new to Earnings Beats, just want to mention we've got a big event coming up on Monday. It is our January effect. You can register now by simply going over to earningsbeats.com. You can click on this. If you click on it, it'll come up to this page, and you can kind of find out a little bit more about the event. I think the January effect is really pretty cool. It's just one clue that we get on how the market could perform in the balance of 2025, but it has been a very powerful clue. You would think, okay, what could trading in January have to do with trading the rest of the year? Well, I think the market is in a certain mindset. When you go in, you have a really good January. It generally leads to a pretty good balance of the year. But where does January 2025 rank relative to all the Januaries that are out there since 1950? That's what we're going to talk about Monday. And depending on where it falls in the ranking, has a lot to do with where we finish the year. It's very compelling. I think you really would enjoy it. It's a members only event, but what I can tell you is we have a 30-day free trial. So you can register with that button, come in for a 30-day free trial. Not only will you get this, but then you also get our portfolios when we talk about those a week from Monday. We're going to be talking about putting, the stocks that we're going to have in our portfolios. And if you go back and look at our history of performance with our portfolios, look at the model portfolio, up 307% since November 19th, That would have been November 19th, 2018, right here, the inception date, up 307%. The S&P during that same period is up 123%. That's some serious outperformance. When you look at portfolio managers who would love to beat the S&P 500 by like 1% a year, that would be massive. And we are absolutely just crushing it. We're up by more than 180 percentage points above the S&P 500 over the past 6 years. Just a little bit more than 6 years. So pretty amazing. This quarter, we're up 15.15% versus 1.84% on the S&P 500. Aggressive portfolio has been equally strong, maybe not quite as strong as, since the inception, but pretty strong, more than 50% higher than what you would have gotten on the S&P 500 simply by following our aggressive portfolio. And that dates back to May 19th, 2019. So, and this quarter, 9.37% versus that S&P 500, 184. I do want to just clarify for this quarter, I'm not talking about January of, just the calendar quarter. I'm talking about this fiscal quarter when we do our drafts. We always draft 10 equal weighted stocks in our portfolios on February 19th, May 19th, August 19th, and November 19th. And then we hold them for 90 days. So February 19th is coming up, and we'll be going over those stocks for the draft next Monday. So that's all part of your free trial. If you're on for 30 days, you'll get that as part of your free trial, which is pretty amazing considering the results that we've had. Anyhow, make sure you sign up. Last couple things I want to look at before we wrap this thing up. Here's a list of all of the S&P 500 and or NASDAQ 100 stocks. And I put them all in one chart list so that each week, I show this in our weekly market report that goes out to our members. That's part of our service as well that you'll get by signing up for a 30-day trial. But this is just a quick snapshot of some of the top stocks from last week. So Super Microcomputer, which has been one of the real beaten up stocks in 2024 and into 2025, starting to show some legs here. I'm going to pull this chart up and I'll look at Expedia, which is number 2 on the list. But look at this volume starting to pick up. This could be the start of something much bigger for SMCI. I'm kind of watching it patiently. I think the biggest number on this chart is up at $50. I mean, we could go up there again, maybe hang out and then pull back again. I don't know. But moving back through these moving averages and trying to get back through this gap resistance and the recent high in early January 2025, I think that would be really big. And don't overlook the fact this volume's picking up. Looks like there's some buyers coming in. The other one I wanted to mention was Expedia. Expedia, 202.37 where we closed. This is a stock that had been consolidating, but then came out with its earnings after the closing bell on Thursday. Blew the numbers out of the water. Revenue, earnings per share, easily surpassing Wall Street consensus estimates. And we got a big gap up, clearing all of this overhead resistance on the open on Friday. I always love to see that. I love to see sideways consolidation after an uptrend and then a gap up above resistance, because I think that this bodes for much higher prices down the road. I really like Expedia. It's part of the travel and tourism group. I literally just finished writing an article over at Stock Charts. Go over and check that out because I talk about the travel and tourism group. I mentioned Expedia. Another one that is going to be reporting pretty soon is Booking. And Booking has come back and kind of consolidated, started to make a move a little bit last week. They report in 2 weeks. I would not be surprised to see another big report coming out of Booking when they do report. I think that's on February 20th. All right, how about stocks that didn't do so well last week? We got FMC, this was an earnings report. Skyworks, earnings report. Estee Lauder, earnings report. These 3 stocks all down more than 20%. FMC down almost 40% as a result of its earnings. And if we pull up FMC and look at it, I mean, relative strength was just so-so. Actually, it looks like it's been downtrending the second half of 2024. The AD line was moving down, not so great there. And it didn't come out with very good numbers. And you can see the huge gap down all the way down to 34. It was trading at 54 before it came out with its earnings report. SWKS, which is Skyworks Solutions, again, AD line just going sideways. Look at SWKS trending lower for the last several months. relative to the semiconductor group. Right before earnings, it was near a 52-week relative low. These are the kinds of stocks I like, leading stocks in leading industry groups, not weak stocks within, average industry groups. And that's what we have with SWKS. So I think you got to be careful going into earnings reports anytime you have a company like this that's been performing as poorly on a relative basis. Not a very good AD line. I think that combination, I just wouldn't take the chance going into earnings. And you can see in this case, Skyworks did, after not looking very good on its chart, did post some poor numbers, and the market reacted not so kindly. All right, that's basically it. That's all I wanted to go over this week. I think more importantly, what's going to happen next week. First of all, come on in for our event on Monday. That would be, for starters, it's going to be another hint that we're going to get where the market's going in 2025. And a lot of the short-term warning signs I'm seeing, could play into more what happens next week and the week after as we start to move into the second half of the first quarter. But just be careful out there. This is not an easy market right now. Volatility is up a little bit, so that means the market's a little nervous. I think that's one reason to be a little concerned. These failures to break out 52-week and all-time highs, another reason to be concerned about the market. Just wouldn't be surprised if we consolidate, maybe even sell off a little bit for a period of time. But hey, never know. Let's see how we open on Monday morning, and we'll go from there. Everybody have a great rest of your weekend, and we'll be back next weekend to do it all over again. Happy trading.